Well, hello, everyone. Happy Friday, and welcome to the first edition of Cordant's 2310 monthly educational webcast series that we're going to be doing. As I just mentioned, this is something new for us, so we're going to see how it goes, and I would be interested in everybody's feedback. What went well? What didn't go well, what was helpful, what wasn't, and what topics do you want to see us cover, and what questions do you have? Financial education has always been an important part of what we're doing at Cordant, both for clients and for others. And so this is just a further extension of that. Hey, Brenda, welcome. Good to see you. And so what we're going to be doing is this 2310, as I mentioned, we're going to be doing 23 minutes of financial education and then 10 minutes of Q&A. And this name 2310 is actually our suite number. So that's where that comes from. Today we're going to be looking at is now a good time to invest, and looking at kind of where the markets are right now, some economic data, and then looking at a framework of, is now a good time to be invested. So we're going to get into that just real quickly, some logistics before we do. There's a Q&A function. We allotted, again, 10 minutes for Q&A. Want this to be interactive. Didn't get any questions ahead of time. I'm going to address a couple questions that we get frequently from people and go about it that way. But if you have questions, definitely put them into the Q&A box at the bottom, and we'll address them that way. Before we get into the presentation, the only other thing I'll mention is we do have a resource page that we'll be putting the recordings for this and the slides out there. So if you missed it, or if you wanted to see it later, look at the slides, those will be available if you wanted to share it, something like that. And if you're not a client, there's going to be ways to get in touch on that page as well. So with all that said, let's get into it and look at our agenda for today. So educational topic, again, we're going to cover is now a good time to invest. We're going to look at what's going on in the markets and the economy. We want to look at a framework to think about getting into the market. And here, think about the scenario of someone that's either maybe you've accumulated some cash and you're wondering, is now a good time to put this cash to work? Maybe you've sold an asset, you've sold a business, a home, something like that, and you have money that you want to put into the market, or you're thinking about putting into the market. Or maybe you're already invested, right? And oftentimes as the markets get bumpy, the same question is, should I get out and get back in later? I think this framework applies to kind of all those different scenarios. And we're going to walk through an example of really, if you start with a conclusion that you want to be invested or you need to be invested based on your goals and objectives, kind of the scenarios to do that, to get invested, are either a lump sum, put all the money to work up front, or average it in over time. So we're going to look at that example and walk through that. And then last, again, we're going to allot some time for some Q&A. So that's our roadmap. Before we get into kind of the first things, the market, the economy, I did want to just start with a story. So we're talking about, is now a good time to invest? Inherently, that's a prediction about the future, and we try to stay away from the prediction business. Obviously, it's really difficult to do, and more make decisions where the odds are in our favor. Recently, I came across this example that I think is at least a humorous depiction of why trying to make predictions of the future is so difficult. So in 1999, the Michigan Wolverines were playing in the Orange Bowl down in Florida, and a reporter for the Tampa Bay Times wrote an article, said something like, the quarterback of the Michigan Wolverines happened to be named Tom Brady. I don't think we're going to hear much from him after this game, after the Orange Bowl's over. Fast forward, 20 years later, Tom Brady's now known as one of the greatest quarterbacks of all time, certainly of his generation, and just signed a $50 million contract with the Tampa Bay Buccaneers of the same town from the journalist who made that statement. So certainly we've heard of Tom Brady. We probably haven't heard of the reporter, what he's up to these days, but it just goes to show kind of the Yogi Berra quote of predictions are hard, especially those about the future. So take that for, we're not going to try to make predictions necessarily about where things are headed, but we do want to apply a framework for when are the odds in our favor. So first up, just real quickly recap where we are year to date. What we're looking at a chart here is just the S&P 500, the largest 500 stocks here in the US this year, how they performed. And you can see, you know, everybody probably remembers in February, it was around February 19th, actually, the market peaked this year and we dropped about 34%. Since then, late March, we're actually up about 34%. So a 34% drop with a 34% rebound, pretty quick rebound from there. Kind of the way math works, it doesn't mean that we're back to even. A 34% drop and a 34% increase. The market's still down about 6% for the full year. It's down about 10% from this peak, but we have had a very nice rebound, obviously, from there. A little bit more context. We've shown this slide before in some different presentations, but I think it's helpful to frame it in to remember a couple things. You know, how normal was that drop of 34%? And it's a very normal bear market drop. The average bear market drop was 35% historically. And then what does it look like after we get a bear market drop? Well, you know, if you go out 1 year, 3 years, 5 years in the future, depending on what market you're looking at, you know, returns tend to be pretty strong. I would say the unusual thing about this market, there's obviously some unusual economic circumstances, life circumstances, things like that. From a purely market perspective, what's unusual is just the speed of the drop and then the speed of the recovery. But it is pretty typical to see a 35% drop, and it is pretty typical to see strong returns thereafter. If you're looking at the US total market, which is going to be in green here, or if you're looking at small company stocks, you know, those tend to rebound even faster. Typically they get hit harder or drop more in a downturn, but they do tend to rebound more and have stronger returns after a drop. So that just kind of frames it in where we are from a market perspective. One kind of question that we get, or if you're reading any of the financial news, the difference or the kind of the disconnection between what's going on in the economy and what's going on in the market. You know, that can be kind of a tough circle to square when you see record unemployment numbers and millions of people filing for new unemployment claims, and yet the market's going up. So the question is, you know, what's going on? Is the market rigged? Is, you know, something else going on? You know, what's happening? And so we're going to look at some of the data, and I think the key thing to remember here is the economy or economic data is what's happening now. What the market is trying to do is predict or discount cash flows into the future. What's going to happen later? What's going to happen down the road? It's not so much the profits of companies this year, it's the profits and prospects for companies in the future. And so again, economic data is now, the market is trying to figure out what's going to happen later and put a price on kind of the consensus, what everybody thinks is going to happen for companies down the road. So that's, I think, a framing that's important to keep in mind. Some data behind that. So this is essentially what we're looking at is data on GDP, which is an economic measurement, versus the market, S&P 500 returns in any calendar year. So there's a lot going on in this slide. It's pretty busy, but what you're looking at is GDP growth here on the bottom, you know, positive growth over here, negative growth down here, and then market returns, positive to negative. So if you're looking at GDP returns in this year versus market returns in this year or the current year, what you can see is there's basically no correlation. You know, the trend line is flat. There's no relationship between the two things. If you're looking at data this year, returns this year. Where you start to see a relationship, and obviously this isn't perfect, but where you start to see it is if we look at GDP growth next year, that should be actually a better indication of what the market's going to do this year. And so that's something to consider. Obviously, if you go out here, GDP growth 10%, you know, on average, the markets are up. If GDP next year is up 10%, the markets should be doing well this year. So that, I mean, obviously we don't know what GDP is going to be next year. Gets back to that prediction business, but This is what the market's trying to do, figure out where we're going to be next year, not what the economic data is today. In terms of economic data, the other thing to think about with the market is it's not so much what the numbers are, good or bad, it's are the numbers that are coming in, or is the economic data that's coming in better or worse than expectations? And so what you can see here is initial unemployment claims. The numbers are terrible. It goes from 200,000 people applying for unemployment at the beginning of the year to 6.8 million, a 30x increase. But again, we had a couple weeks back a number of about 4 million. I think it was this week. And the market actually went up on the news because the consensus expectations were for more than 4 million people to file claims. And so again, it's better or worse than expectations is what the market's going to respond to. The other thing to consider here is it's trending down, which is good. Historically, the market or the economy has actually tended to move out of recession 2 to 3 months after initial unemployment claims peak. So we'll see. Obviously, things could be different, but historically, that's kind of been the trend. So if the recession is over 3 months after initial unemployment claims peak, I mean, if this truly is the peak, we're talking about end of June potentially being out of the recession. So we'll see. But in terms of economic data, I think those are two helpful lenses to be thinking about when you're looking at some of this data. More economic data that we're kind of paying attention to: new home sales. Housing is a big part of the economy. It kind of drives a lot of the economy. And this was just very shocking data here, which was new home sales in April were 623,000, which actually was a gain over the prior month. And the expectations, again, back to that expectation thing, the expectations were for a negative 23%, a 23% decline. So literally a 24% difference between what the actuals were and what the expectations were. So this is, 0.6% increase might not be a big increase, but in terms of expectations, kind of blew it out of the water. Other things to look at are more short-term data. These aren't big economic data, but in terms of as the economy starts to open back up, is the economic data kind of picking back up and taking a look at that. So this is just real estate showings. Again, back to real estate being an important driver of the economy. The orange line here is 2020 and the blue line is 2019. And obviously we saw this huge drop in terms of the number of real estate showings, March and April. And again, in April, you've started to see this pick back up, and in May, we're actually back to where we were at this point in May of last year. So imagine there's probably some pent-up demand in here, right, for showings that are driving this, but interesting that we're already back to where we were last year in May in terms of number of showings. Moving to a couple other indicators here. So this is mortgage purchase applications, and you can see the bounce back here. TSA passenger screenings, so going from April, kind of the low point there in April of under 100,000, and we've seen kind of the ramp up there. And then restaurants, basically flatlined, right? Nobody could, even if they wanted to, go to a restaurant. And this is from some selective states that are starting to reopen, and you're seeing this pick back up. So you can look at different data points in terms of vehicle miles driven, fuel consumption, things like that. But as the economy opens, you are starting to see a bounce back in the data. And again, the market kind of has the data from the shutdown, right? Restaurant business went to zero. Travel, fuel, all that stuff was very low. We kind of know what the bottom was, hopefully the bottom. What kind of the question is now going forward as it starts to ramp up, is it better or worse than expectations? So those are kind of the things that I think are interesting to kind of just pay attention to as the economy ramps back up, but kind of that framing between what's going on in the market, what's going on in the economy, and better or worse than expectations, and kind of looking out into the future, not necessarily today what GDP is in terms of what's mattering. Okay, so now moving on to kind of our title topic here, which is now a good time to invest. Given all that information, given that we're not necessarily trying to make predictions about what the rest of this year looks like or something like that, what is a framework to decide is now a good time to invest? So again, if you make the assumption that you need to be invested, either to meet your goals or you just want to be in the market, there's basically two options. You can either do something called dollar cost averaging, which is fairly simple. If you have a certain amount of money, instead of putting it all to work today, you would split it up over a series of periods and get it invested. So maybe you have $100,000 that you want to get invested, and you're going to do that over 4 months. And so you'd put $25,000 into the market each month for 4 months, and then that whole thing would be invested. That's dollar cost averaging. Our other option would be lump sum. We just take the $100,000 today, we invest it all, we're done with it, and we see what happens from there. So those are kind of the two options that we're going to walk through and provide a framework around. Vanguard has done some work on this to try to quantify this, and so we're going to walk through that, and we're going to walk through some other analysis that has been done as well. But this is just a very high level depiction of what that looks like. So starting here on the left would be a 60-40 portfolio. So that's the target weight. And then in green is the cash, right? And so here, 50% of the portfolio is in cash, dollar cost averaging in, you do a period in a chunk in period 1, a chunk in period 2, a chunk in period 3, and then by the end, you're at that 60-40. So this is what that dollar cost averaging looks like visually. So Vanguard, as I mentioned, did some analysis on this, and they wanted to look at, okay, dollar cost averaging versus lump sum, what's better off on average and what's kind of the magnitude. And so what they found is, on average, lump sum investing, you're better off, right? Something to the tune of 2/3, 70% of the time, you're going to be better off just putting that money to work today and not averaging it over time. So that's one piece, kind of what are the odds that you're better off doing one versus the other? So 70% of the time, roughly, you're better off just putting the money to work up front. And that makes sense. I mean, over time, the markets are up, 7 out of 10 years, roughly, the markets are up. So that kind of 70% time makes sense. The other piece to this equation is, well, what's the magnitude, right? Of how better off are you then? If you're better off on average than lump sum, well, what's the magnitude? So they looked at a 12-month period, and it's somewhere on the order from 2.5% to 1.5% roughly. Over a 12-month, so on 1 year, you're 2.5% better off by putting the money to work up front. And this is for a 60-40 portfolio, 60% stocks and 40% bonds. So on average, we know we're kind of better off doing the lump sum. It doesn't include kind of this the main reason that people are going to do it, which is kind of a risk mitigation strategy, which is, I know on average I'm better off, but what if I get one of those bad periods? And what does that look like? So what they've done here in the analysis is taken a look at different deciles. So looked at, 1 would be the worst performing 10% of the time, and 10 would be the best performing 10% of the time for the market. And what does it look like if you compare these two methods, dollar cost averaging versus putting all the money to work up front? And so what you see, I mean, we looked at that 70% figure. So what you can see is down here at the bottom, the lump sum investing outperforms. It's a better method. So you see 70% of the time in deciles 4 through 10, you're better off by just putting all the money to work up front. In the bottom 30%, you're either, it's essentially a push, or in these bottom two scenarios, you're better off actually investing over time. And what's interesting kind of is the magnitude. So how much better off are you if you get one of the worst scenarios? And, it's roughly 7-ish% across markets over time. If you get one of the worst performing periods, you're better off to the tune of roughly 7%. All the other periods, it's either kind of a break even or you're better off putting it in up front. So I think the thing to know here is, this is kind of what you're protecting against if you're doing it this way. Looks like we have one question that's coming in, and I'm not able to hit it right now. I can't click over to it, so I'll save it for the Q&A, but know that I see the one question out there. The other thing we want to look at, I'm actually going to go slide back on this for 1 second. The other thing we want to look at is, this kind of tells us kind of a static, a 12-month snapshot if we invest a lump sum or if we average in over time. The other thing that we want to consider here is timing. So how you could average in over 2 months, 4 months, 6 months, 8 months, etc. You could go out to 5 years. How does that impact the decision? How frequently should we, how frequently, or what should be the cadence of investing the money? And I think the kind of the conclusion here, I'll kind of steal the conclusion and I'll show the data. The conclusion is, on average, the faster you invest it, the better off you are. If you stretch it out too long, your odds of that being a favorable decision, go down. The question that came in was, is the dollar cost averaging versus the lump sum assuming an up market? And so no, it assumes all market scenarios. So what they've done is looking at the United States, United Kingdom, and Australia, and it's looking at all the market scenario, all the data that they have, both up and down markets. And so basically, if you have a down market, this is probably this scenario where the systematic is going to outperform the dollar cost averaging. If you have an up market, the lump sum is going to outperform. Okay, so let's look at this next chart. And what it does is it shows the magnitude of this, and it looks at monthly periods going from 2 months out to 60 months. And what you can see is in a 2-month period, it's this roughly 2/3% of the number that a lump sum is going to outperform. And it outperforms very low, less than 1%. If you stretch it out to 5 years or 60 months, it actually goes out to 95% of the time. You're going to be better off on a lump sum. And the magnitude is about 17%. So let's look at the data here. And what you can see, this is just a video image here where it's rolling it out by 2 months. I'll let this run a couple times. But what you can see is that black line dropping down, which means the dollar cost averaging is underperforming lump sum. So the conclusion here is kind of the longer you wait, the less frequency you're going to have of outperformance, and the magnitude of that underperformance is going to get longer the longer you stretch it out, is kind of the conclusion here. So Vanguard looked at just a 12-month snapshot. This is kind of rolling different periods, and you can kind of dynamically see how that line comes down the longer that period gets stretched out. So that's kind of it on the data. I wanted to kind of summarize, is this a good time to invest, and dollar cost averaging versus lump sum. The 3 things that I think are important to consider here are, if you're going to do a dollar cost averaging strategy, make this specific to you, not a prediction about where the market is going or headed. Don't do it because you think the market's going to head down. Do it because it's the right decision for you from a risk management perspective. Kind of, the other way to think about that is, you're going to be more disappointed if the market drops and you got everything invested up front than you are if the market goes up and you missed out on some of the gain. So risk management, not return enhancement, would be one reason to do a dollar cost averaging, and that would be specific to you. The other thing, which is kind of that last chart that we saw, sooner is better than later. So if you are going to do a dollar cost averaging, you're on average 2 months is better than 4 months, and 4 months is better than 6 months, and on and on and on. So don't stretch it out too long would be the encouragement. And again, some of that's just going to be individual preference, but the odds are the sooner you do it, the better from a return perspective, from a data perspective. And then the last point to note here is just set a schedule. It's going to be a lot easier to do it. Obviously, if you're working with us and we're doing it for you, we're going to have that schedule and we're going to execute it for you. But getting that schedule in place is important, because it's hard to know what things are going to look like, how you're going to feel in a month if you're on a monthly schedule. And so, picking the day, picking the cadence, I think is the right way to do that. And it ensures it gets it done. It's on the calendar, it's going to happen. And it ensures that, you don't change your mind at some point, either doing it early or doing it late. And so set the schedule is important. So those are that's the 23 part of this 2310, 23 minutes of financial education. Again, hope it was helpful, hope it provided some good perspective. And, we want to dedicate some time to some questions. So again, I'll just prompt, if you have any questions, either based on anything that we looked at already, or anything that's on your mind, go ahead and shoot it into the Q&A, and we'll get it addressed. So I'll just kind of give you guys a chance to submit any Q&A that you have there, and I'll hit a couple, maybe I'll hit a couple other things that are kind of starting to come in terms of things that we're hearing. So one would be some questions around inflation. So obviously, if you've been reading the Wall Street Journal or whatever, you know that the Federal Reserve has done a fair amount to expand their balance sheet to support the economy. Congress has done a lot in terms of the CARES package and stimulus packages and things like that. And so the question is, are we going to see some inflation? And I think, again, the way to think about this is hard to predict, but some perspective. So traditionally, when we go into a recession, we've had recessions in the past, the initial pressure is going to be on the deflationary side of things. The economy has slowed down, people are earning less money potentially, and the pressure is going to be on prices falling. The question is, kind of after that initial period passes, do we get in an inflationary period? And so, I think right now we're definitely in this scenario where we have some deflationary pressures. The time will tell on the inflation perspective. But I think a couple things to think about is, from an inflation perspective, yes, the Fed has pumped a lot of money into the economy. Their balance sheet has gone from about $4 trillion prior to everything that's happening to about $7 trillion now. So a pretty big expansion of their balance sheet. However, the other piece of the equation in terms of driving inflation is something called the velocity of money, which is essentially those dollars that are in the economy. How often do they get spent, or how often does it get turned over? And what you've seen, and what's pretty typical actually in a recession, is the supply of money goes up, but the velocity of money goes down. So if inflation is kind of the combination of those two things, one going up, one going down, you're sort of still back at that baseline level. And so that's one thing to think about. The other thing to think about is just people's behavior. There's some data that came out today, which is just really shocking, that actual incomes have gone up because of some of this, the $600 supplemental unemployment insurance that's out there right now. People's income has actually gone up, but they're not spending that money. So savings rates have gone up to like record levels, actually. So people are putting that money aside, emergency fund, rainy day fund, whatever you want to call it. So that money is not out there being spent, driving inflation. The only other thing I would point out on inflation is kind of in the world we live in today with demographics and technology and things like that. There have been countries, Japan would be one, that have been more or less begging for inflation. They're in this deflationary scenario and expanding their balance sheets and things like that. And the country is highly indebted and they're not getting inflation. And so I think it seems in today's day and age, deflation is actually the bigger risk than inflation. But obviously, time will tell. And, it's one of the important considerations when building a portfolio. Bonds and things like that are going to do well in deflation, going to do well in times of recession, things like that. But it's important to have the counter to that, stocks or things that can grow and things that can keep up with inflation as well. So that's one thing to consider. It looks like we're getting another question here. I'm gonna stop my share here, and so I can actually see the question here. So the question is there any changes in recent years that might change the advantage of value over growth stocks, large companies buying up value companies? So yeah, this is one other thing that we've been reading about a lot, getting some questions and stuff like that. And the couple things to consider here, I would say, are one, just to kind of set the framework, for the last 10 years roughly, we've seen a period where growth stocks, so these are technology companies, typically companies that are growing quickly, have really outperformed value stocks, things that are companies that are less expensive. So these would be maybe companies that are going through some periods where it's not the best period for the company, but they're selling at a discount, rightfully so. Traditionally, going back, if you look at the data, the cheap stocks, things on sale, outperform the growth stocks. Some of that is a risk premium, right? You're compensated for providing capital to that company that's maybe not the Microsofts of the world that have the huge cash on the balance sheet and are pretty safe and have grown pretty well. Part of that is, depending on what you're looking at, is kind of just the markets move a little bit too far in one direction, right? The companies are growing and they have a really high growth rate, and it's really hard to maintain, versus the company that's maybe struggling a little bit. The prospects are really terrible, and those really terrible comps are a little bit easier to overcome than the really good ones. So that's kind of the backdrop. Question is more around recently, has the world changed in such a way that might no longer work? There's some analysis that was actually recently done by AQR. We don't use them for their value strategies, but they do have some value strategies. And so they wanted to dive into this topic to look at, is something different about the world today that would make these strategies not work? And what they were able to do is essentially look at, kind of tease this out. So take out pieces of the market, the growth companies that are buying maybe the smaller companies, or other characteristics, any of these criticisms that people put out there on one strategy not working versus the other. And what they were able to do is look at the spread between how expensive is a growth company versus value company, and say, okay, that's the spread. Now, if we take some of these other factors out, so if we take out the big 5 tech companies, what changes? If we take out some of these other things, what changes? And what they found is these ratios, basically nothing changes in terms of the analysis. If we use price to earnings instead of price to book, or some of these different measurements of value, kind of what changes? And what they found is, the data still shows that even if you exclude some of these reasons that it wouldn't work, you're still showing the valuation spread between the two. And so there's no reason to expect the strategy shouldn't work going forward, even if you account for some of these reasons that people put out there. So pretty interesting piece of analysis. I mean, it's kind of technical, it's pretty long, but I can go ahead and put it out there on the site if anybody wants to review it as well. So I think that is it in terms of our time. Trying to stay sensitive to this 23:10, so we're coming up on the 33 minutes, and I don't see any other questions out there right now as well. So that's it. Again, hope this was helpful. First time doing it, and so definitely would encourage feedback. What was good, what was bad, and what would you like to see more of, and send us your questions going forward. So that's it for today. Hope you all have a happy Friday. It's sunny here. Hope it's sunny where you're at, and have a good weekend. All right. Thanks, everybody.